Okay, looks like we're live. It's 10 o'clock and it's Wednesday. It's time for our weekly webinar. Good to see everybody. This is the last week of June, so I hope you're enjoying your summer thus far. I'm looking forward to the rest of the summer. It's been fun so far. I don't know how it's been for you. I know a lot of you are traveling, so I like to hear the travel stories. But anyway, let's get into our weekly webinar. We're going to follow our usual format. We're going to talk about some updates from the Slott group. We were off last week for the holiday, so I had quite a bit of material to go through, but I think I got you two topics and two reports that I think you're going to enjoy. And we're going to talk about the markets. Again, a little bit of catch up from the markets. It's been a little choppy, but not a lot of activity. No big swings anyway, but we'll talk about that a little bit. And then we're going to get into our financial planning topic, our financial 15. And this week's financial 15, we're going to talk about when not to convert to a Roth IRA. So this came about from a conversation I was having with a person who contacted us from Florida. And I just told him it doesn't make sense. It probably doesn't make sense for you to do any more or consider Roth conversions. And he was very surprised by that. But the Roth conversion strategy is one of the best tools that we have for tax efficient planning, but there are times that it doesn't make sense. So we're going to talk about those. So stay with us for the financial 15 and we'll go over that. So good to see everybody. Just say hello and let me know that you're out there and that you're hearing me okay. I want to just reiterate my goals for you as listeners. This is an education channel. This is not advice. We're starting a podcast and I'm toying with the name Not a Guru. I want to tell me what you think about that. Hi, Denise. Hi, Paul. Good to see you. And I say not a guru because there's so many people out there sharing financial advice that, first of all, may not be qualified. They may not have a lick of certification or training or time in this industry and expertise to be able giving this financial advice. But even if they are the brightest person in the world when it comes to financial advice, financial advice is very individualized. So my belief is that you should be using tools such as YouTube, even this channel, to gain education, but you want to have individualized advice. So my goals for you are to be inspired by this education, inspired to make changes, open your mind to different ideas and ways of thinking about planning and investing, educated so you feel confident in the plans that are put in place. I want you to stay educated so you can have that level of confidence. I often talk to folks about our review meetings. These review meetings are often review and remind. Why the heck are we doing this? Why am I writing this big check to the IRS now instead of waiting for later? Why am I positioning my investments the way they are? These are a re-education, because often we're working against 20, 30, 40 years of incorrect programming when it comes to financial planning and investment management and tax efficient planning and all the things that we talk about. I want you to stay updated. So come onto these webinars live like many of you are today, or you have the opportunity to see them on the recordings when I send them out to our email list. And some of these videos, and I never quite know what it's going to be, but some of them, a few hundred people watch a week, and some of them, a few thousand people watch. We've had one video that went over 10,000 viewers, and that may not be a lot in the YouTube world, but it's a lot to me. It's just shocking that there are all those folks out there. And then there was another one that went over 6,000 views. So that's really, really interesting. And again, why I kind of give that caution at the beginning of this is that this is education. I don't want you to take this for specific advice. So let's get into our program here. And good to see everybody. So Paul and Denise, I said hello to, and Martin, good to see you. Leighton, good to see you. Jerry and Stefan. Stefan might be new. Good to see you, Stefan. I apologize if we've talked already, but good to see you. And it is, so Stefan's in Pennsylvania, and many of you are in Pennsylvania, but we've been getting contacts from all over the country. Like I told you about, the person I'm going to talk about today during the Financial 15, he's from Florida, and they discover us in different ways, including YouTube. So let's talk about what's coming up. So I was invited to be on David McKnight's podcast again, and it was supposed to be for this Thursday or Friday. I forget which day, but David's away on vacation, and he let me know that he's in a place where he doesn't have a steady internet connection. So we're going to do it another day. So keep your eye out for that, or your ears out for that. So if you don't listen to the Power Zero podcast already, you should. Or if you don't follow David McKnight on YouTube, you should. And if you don't follow us, you should. So you should hit that subscribe, like, and notification buttons, or those subscribe, like, and notification buttons. And we will you'll be updated. So you'll be updated even before you get the email for the recording, because once we take this live broadcast where I'm going off topic, or maybe we're dealing with a technology thing, because this is live, and you that have been following this know that, because sometimes things happen. Good morning, Jim. We package that and we clean it up, and then we send it out in an email over recording. But once that's repackaged and posted on YouTube, then you get notification if you're a subscriber. So you get to see it first, kind of. So we have that coming up with the David McKnight podcast. But again, if you haven't signed up for or listened to David McKnight's podcast, you should. It's really good information. So let's jump into the Slott report, and I'm going to have you read along with me here. So Sarah Brenner writes, and she's talking about don't overlook your beneficiary form. I'm going to tell you a secret. I had a different report up this morning that had to do with Roth 401ks, and it was good information, but this is so important. If you attended our Changing World of Retirement Planning classes, or if you've spent any time listening to me in person or on YouTube, I talk about the importance of updating and reviewing your beneficiary forms. This is one of the most powerful tools that we have in estate planning, because if your will says one thing and your beneficiary form says another, most of the time your beneficiary form is going to override that will. So it's really, really important to pay attention to those beneficiary form designations. And this is going to talk about IRAs, but it's not just IRAs. Of course, it's your retirement plans. It's any annuity contracts you have. It's even bank accounts and investment accounts can have beneficiary-like designations in the form of transfer on death and payable on death designations. So pay attention to those things if you're using them. And if you're not using them, you should consider it. You don't ever want to have a blank beneficiary form, and you don't also want to have an incorrect beneficiary form. So there's only one way to ensure that takes place, to have correct beneficiary forms. And I wish you could all say it with me. That is, you review your plan every single year, so you make sure that all of these things are correct. Make sure you have a checklist in place to make sure that your beneficiary designations are correct. So let's read what Sarah wrote. Sarah writes, you have been contributing to your IRA for years. The market is up and you are watching those investments grow. Maybe you have rolled over funds to your IRA from your company plan. You may now have a significant balance. So far, you have taken smart steps to a secure future. Don't stop your careful planning there. While you have been saving for retirement, you may not have been thinking about what happens to your IRA after your death. An IRA is not only an important part of your retirement, it's also a significant part of what you will leave to your heirs. You will want to carefully consider what will happen to your IRA after you die. So I am up here where it says your will does not determine who gets your IRA. Your will does not determine who gets your IRA. Many people believe that their will determines who inherits their IRA. This is a common misconception. Your will has no effect on who will receive your IRA assets, because IRAs are generally not part of the probate estate. In other words, IRAs pass to beneficiaries outside the will. Even if a perfectly drafted will by an expert attorney, let me say that over again. Even a perfectly drafted will by an expert attorney will have no control over what happens to your IRA after your death. Don't overlook the beneficiary form. The main estate planning document for IRAs is the beneficiary designation form. This form, not a will, will determine who inherits your IRA funds. This is a form that you most likely completed with the IRA custodian when you established your IRA. On a standard beneficiary designation form, an IRA owner names one or more primary beneficiaries. Additionally, the IRA owner usually will also name a contingent beneficiaries. Contingent beneficiaries inherit the IRA funds if the primary beneficiary predeceases the IRA owner. Update your beneficiary form for life events. You may have established your IRA a long time ago. IRAs have been around for decades and a lot has happened. Consider contacting the custodian of your IRA or checking online to see if your beneficiary designation form is up to date and accurately reflects your intentions. If you are divorced, you will want to be sure that your ex-spouse is not listed on the beneficiary designation form. This does happen from time to time. So they were my words. Let me just start that sentence over again. This does happen, and sometimes this oversight ends up in a court battle as the ex-spouse claims IRA funds, and the IRA owner may have wanted to go to a current spouse or to children. Avoid this legal mess by making any additional changes now. Do regular beneficiary form checkups. Problems can occur when an IRA beneficiary designation form is not clear. All are listed beneficiaries on your Are all the listed beneficiaries on your form clearly identified along with the share of the IRA to which they are entitled? Spending some time now to be sure that everything on the beneficiary form is accurate will avoid significant problems for your heirs in the future. Sometimes the IRA custodian cannot find a beneficiary designation form. We've seen that. This can happen for a variety of reasons, including bank mergers and takeovers. If you discover this now, the solution is easy. You can simply complete a new beneficiary form. If no beneficiary form can be found after your death, there will be a more serious problem as the IRA will be treated as if no beneficiary is named and will be paid out to the default beneficiary listed in your IRA document, usually your estate or spouse. Yeah, this happens all the time because we custody with Charles Schwab, and Charles Schwab bought TD Ameritrade, so we were already part of Charles Schwab when that happened, but or dealing with Charles Schwab, I should say, when that happened. But folks who transferred from TD Ameritrade, they should certainly check their beneficiary forms anytime a bank changes hands. Folks, every single year, because even if your bank has been the steady bank for the last hundreds of years, like there's a bank here in Newtown that's been around for several hundred years, never changed, but they changed their systems and they changed their programming and they changed their operations. So it's really important to pay attention to what's going on and check it every year. There's no reason not to. I often say that there's no reason not to check every single year. Check your plan, check your beneficiary designations. Have that conversation with your planner every single year. You have worked hard to build a balance in your IRA. Taking a few simple steps now to be sure that your beneficiary form is completed, up to date, and accurate will ensure that those funds are passed safely to your intended heirs. So now let's go into the mailbag. The mailbag is when people write in and the Slott group answers questions. And this one is about simple IRA, RMDs, and IRS life expectancy table. So Ian Berger is answering this week. So the first question, does a simple IRA owner who is over age 73 and still works for the same company that sponsors the simple IRA plan have to take an RMD, a required minimum distribution? He does not own any of the company. So here's the answer. Yes, simple and SEP IRA owners cannot use the still working exception to delay RMDs until retirement. For this purpose, simples and SEPs are treated like IRAs, not plans. So the first RMD will be due for the year the simple IRA owner turns age 73, regardless of employment status with the company. So this is a common problem with, whether you're reading articles, getting some education or direction from folks on YouTube, with 401k plans and other and 403b plans, other type of retirement plans. There can be a still working exception. So the still working exception says if you don't own more than 5% of the company and you're over your RMD age 73 in this example, and you're still working, then you don't have to take RMDs from that retirement plan only. But people get confused about that. And first of all, they think sometimes that it's for all their retirement plans. They sometimes think it's for all of your retirement accounts, including IRAs. And this person says, does this apply to my simple IRA, which is a much different plan than a 401k or other retirement plan? So you've got to be careful. These things can get confusing, and you have to know when to ask the question. So next question, I'm trying to get information regarding an RMD, a required minimum distribution for 2024. My husband, 12 years older than me, died in September 23 at the age of 93. Good for him. Not good for him that he died, but good for him that he lived till 93. He had 2 IRAs, and I am the sole beneficiary of both. I was able to transfer them into my own name. For 2023, he had taken his RMD before he died. I'm not able to find out which IRS table I have to use for the 2024 RMD. Is it the Uniform Lifetime table or the Single Life Expectancy table? No matter where I check on the IRS website or any other website, I can't find the answer. Would you have an answer for me? I would really appreciate this. Thank you very much. Gisela. The answer is, hi, Gisela. Once you did a spousal rollover for your husband's IRA to your IRA, you became the owner of those funds. So you would use the Uniform Lifetime Table to calculate your RMD for 2024 and subsequent years. Use a combined balance on 12/31/2023 to calculate your 2024 RMD. And you see my notes here. So we often talk about eligible designated beneficiaries, and there are some notes I carry week after week, and this is one of them. I list the 5 classes of eligible designated beneficiaries. So you'll see this, or I'll just share it with you since it's on our screen. The first is a surviving spouse. The second is minor child of the account owner, disabled individuals, the chronically ill, and beneficiaries not more than 10 years younger than the IRA owner. So they are eligible designated beneficiaries, and I only shared that with you because it was on my screen there. And there are, again, certain notes I keep just for reference on the screen. Okay, let's get into the markets. So let's first talk about, so we're first looking at the weekend review of what happened last week. So I'm going to first share our analyst report and what they think about some of the numbers that came out last week. So the first is retail sales. So retail sales did rise in May, 0.1%, but below the expected 0.2% gain. So that's half, right? The analyst take on the overall numbers is that this report provides more evidence that the consumer is coming under pressure and suggests that the U.S. economic growth may be moderating. So this is important. For now, the consumer slowdown is mild, but investors are watching to see how spending evolves going forward as Fed rate hikes have more of an impact. So we're in June. There was these Fed rate reductions, interest rate reductions, have been put on hold. We expected them. There are a lot of discussions about the first quarter and then June. You know my thought. I don't think that we're going to see anything until the end of the year. Our analysts aren't as pessimistic as I am. It's really not pessimism. We may, right? When we start seeing some softening in sales and softening in the job market, maybe that will stimulate a rate cut by the end of the year. But what we had been seeing prior to this is really continued sturdiness, let's just say, in the economy. So this is good news, and it is important. The retail sales drop, I'm saying. If your gauge is a reduction of interest rates, this is good news for you. If you're in the retail sales business, it's not such a great news for you. So initial jobless claims fell to $238,000 from, I did it again. Jobless claims fell from 238,000 from 243,000 a week ago, while the 4-week average moved higher by 5,500 to 232,750, the highest reading since September. So what does that mean? Jobless claims remain low by historical standards and are showing signs of trending higher. Putting the recent employment data together shows a labor market that is still healthy but softening, as would be expected after the series of Fed rate hikes. So we're starting to see the effect of these rate hikes, which again, from a interest rate management point of view for the Fed, that's a good thing. If we want to see interest rates start to drop, these are the indicators we want to start seeing. Leading indicators, that fell more than expected, dropping 0.5% in May versus expectations of a 0.3% drop, but slightly better than the 0.6% decline we saw in April. So the leading indicator index points to economic slowing, but not falling into recession. That's good news, of course, right? We're way overdue for a recession, so it's likely we're going to see one in the in the very near future, in my opinion. But this analyst goes on to write, however, the predictive power of the leading economic indicator, has lessened somewhat after the predicted recession last year never came to fruition. So this indicator was predicting a recession last year, and it never came through. So what do we have coming up this week? Well, the big one, we have durable goods on Thursday, and that's important. But the big one is the PCE. So this is the Fed favored inflation gauge, which will again be closely watched after a softer consumer price index reading earlier in the month that we saw. So we're gonna pay attention to what the PCE is and see how the Fed reacts to that and what comments the Fed has after the PCE. All right. So what happened last week in the markets? So let me jump back because we didn't have a webinar last Wednesday. So the previous week, the week ending June 14th, we had the Dow Jones was down 0.51%. The S&P 500 was up 1.62%. The NASDAQ rose 3.27%. And other indices around the world were mixed. So just remember that. That's where we were the week before. Now let's fast forward to last week. Where did we end? So for 1 week, the Dow Jones Industrial Average was up 1.45%. The S&P 500 was up 0.61%. The NASDAQ was flat, 0% return. And small caps were at 0.79. Let's see where we were. And then we had some upward trend around the rest of the world, with bonds falling 0.15%. And the week before that, bonds rose 1.31%. So the bond index year to date is still basically flat, 0.09%. So again, it feels like a lot of volatility out there. The big jump in the NASDAQ, of course, but it's pretty tight movement, and that's to be expected. So last week was the holiday week, right in the middle of the week. We're going to see that again. I think with July 4th. I think that's a midweek. No, that's an end. Well, it's Thursday, right? So it's kind of an end of the week. That'll be a short week too, because people are going to take off Thursday and Friday. I think our office is closed on Friday. But when we see these partial weeks and oftentimes in the summer, we see slowdowns in the market. Okay, let's see. So interesting take from our friends at BlackRock again. Where's my BlackRock? There it is. So there's been, for those of you who watch the tech market, it's been a really interesting ride. So we've had a lot of growth, certainly this year and last year, and in certain securities. I'm being really careful not to mention certain ones, but and don't take any of this. Again, this is educational. When I'm talking about the markets, this is education. These are not specific recommendations. You should every decision, whether it's financial planning or investment related, is very individualized, and you should consult your financial planner, your financial advisor. If you want to set up time with us, you can do so by contacting us. I'll just put that up here at questions@attleborowealth.com. That's questions@attleborowealth.com. Alternatively, you can go to our website at attleborowealth.com, and there is a contact us electronic calendar or a digital calendar where you can go in and schedule time for a consultation. But these decisions are very individualized. So I'm being really careful not to mention specific securities, but there's been certainly a tech rally, and then we've seen a bit of pullback from specific securities. But BlackRock wrote on June 24th, sticking with U.S. tech surge. So these are excerpts from a transcript that I read, but they said, we see a small group of tech winners leading stock gains as a feature of the artificial intelligence theme, not a flaw. We stay overweight U.S. stocks. They talked about the S&P 500 at all-time highs last week, led by tech stocks. U.S. Treasury yields held steady near 4.25% during the holiday shortened week. And they talk about the PCE inflation index as well. So they wrote, we're eyeing to what extent U.S. PCE inflation for May shows a slowing of services inflation after upside surprises early in the year. Goldman Sachs had an interesting take on it as well, or take on our Fed as well, and they were talking about divergence from other central bank organizations around the world, the G10 central banks, and it's a very detailed and very wordy description. But basically, what Goldman Sachs is saying is they expect a divergence. There's been conversation of well, other countries are cutting or talking about cutting. Now, what about the U.S.? And are they going to follow along or lead the charge? And the feeling I'm getting from the Goldman Sachs report overall is they're going to stand on their own ground, and they're going to look at their indicators, and they're going to move in their own direction. I'm talking about the U.S. Fed, for what they think is best. All right, that is the market. Let's see if there's any questions. Stephen asked, does Attleboro offer a complimentary retirement health check? Yeah, I just talked about that, actually. You can schedule time on the website or send us an email at questions at attleborowealth.com. That's questions at attleborowealth.com. Okay, moving on. So I'm just setting up my whiteboard here. Stay with me. And then I'm going to talk about the Financial 15, but we're not quite there yet. So I draw on a whiteboard, and I'm just setting it up so I can draw on it without accidentally unplugging it. Okay. All right, so this is the Financial 15 section of our webinar. So if you're just joining us for this section, then please hit the subscribe, like, and notification button so that you receive notifications when we have new videos or new topics. So in today's Financial 15, we're going to talk about when not to convert to a Roth IRA. And you might be surprised to hear me say this, because many times, and including on one of my recent podcasts or webinars with David McKnight, who's really a thought leader in tax efficient planning in the country and probably worldwide at this point. But I said to Dave, the Roth conversion tool we have is a real gift from the IRS, because all we have to do is decide what tax we want to pay today. And if we know the tax rates are going to be higher in the future, it can make sense to potentially pay tax at a lower rate today, convert those assets to Roth IRA, and never have to pay that tax again. So that sounds really good, but there are times when you should not do that. You should not take advantage of that tool at all, or maybe it's your time is done with your conversions. So let's talk about first, what is a Roth conversion? So what is a Roth conversion? I'm going to explain that using our buckets. So those of you who have followed us for some time recognize these buckets. You've got taxable bucket, tax deferred bucket, and your tax advantage bucket. So your taxable bucket, you've got a certain amount of money that you should keep in here. Most experts agree that this should be 6 months to 1 year of expenses, not income, but expenses. And we know that this is a taxable bucket because every year we get 1099s for interest, dividends, short-term capital gains, long-term capital gains. Sometimes we get K1 income out of here, and all of those types of reports that I just told you about, the 1099, all that equals tax. So you've got to pay that tax every year, whether you reinvest your dividends, whether you take out those dividends, and you got to pay capital gains when you liquidate positions or your mutual fund liquidates and rebalances for you. But there's a lot of limited control with that taxable bucket. So we like to keep that amount as low as possible. And again, usually 6 months to 1 year of expenses is what we want in this taxable bucket. Then we have your tax deferred bucket. So that's over here. So that's your IRAs, your 401ks, 403B plans, simple. We talked about simple IRAs a second ago in our weekly webinar section. What else? SEP IRAs. Just think of it as anything that you promised to pay tax on later. You get a tax deduction or didn't pay tax on that money that went into this bucket, but then you have to pay tax when you distribute from that bucket and you pay in the form of what's called ordinary income tax. So it's just like you earned it. So that fills up your tax bucket and you pay tax wherever you land on there. Then we have the tax advantage bucket. So we know something is tax advantage when it doesn't cause your you don't pay federal tax, you don't pay state tax, you don't pay capital gains tax, and it does not cause your Social Security to be taxed. So there's only two things that are truly tax-free, and one is a Roth, anything Roth, Roth IRA, Roth 401k, Roth conversions. Of course, there's requirements with all these things that you have to keep up with, the 5-year rule and whatnot, and there's details within Roth requirements, but generally, if you've any qualified distributions from a Roth IRA, Roth 401k, are tax-free. And then the other truly tax-free vehicle is cash value life insurance or properly structured cash value life insurance. Some people refer to this, and my friend David McKnight refers to this as a life insurance retirement plan. But today we're going to talk about Roth. So what is a Roth conversion? Now that we know how our buckets are structured, what is a Roth conversion? So the IRS code allows for us to take funds from this tax-deferred bucket and convert it. It's actually a distribution. It's a distribution from your IRA or your 401k or your simple or SEP. But it's simplest to do from your IRA. So let's just stay with that. So it allows you to take money from your pre-tax account and distribute it and pay tax, and then it is recharacterized or lives in your after tax, right? So your tax advantage, your Roth. So now any growth you'll have from that conversion, as long as you've met the qualifications and requirements, will be distributed tax-free. So it is actually a distribution that you're allowed to redeposit into Roth. There's only two ways to get money into Roth IRAs. One, and Roth 401ks or retirement plans. One is contributions, and two is conversions. Contributions have many requirements and restrictions. Some of them have to do with income limits and phase-out levels. Some of them have to do with whether you have earned income or not. If you're talking about Roth IRAs, and 401ks have some restrictions as well. You can only put in so much. But conversions, they tell us that in the tax code, we can do as much or as little as we'd like. You could convert $1 million a year. You could convert $1,000 a year. And if you have $100 million, well, geez, you could even convert that total amount if you wanted to in 1 year. There are no speed limits on this. The determination is how much tax you want to pay in the transfer, because the tax has to be paid as you're crossing that bridge from tax deferred to tax-free or tax advantaged, or as my friend and mentor Ed Slott says, from forever taxed to never taxed. It's really forever taxed to never taxed again. But the question is, how much and how much tax do you want to pay? So really, really great tool. I think you'll agree that if we have this tool and if we know, well, geez, our tax rate seems high today, but it's probably the lowest that we're ever going to see in our lifetime. And we know the taxes are going to be much higher in the future. And in fact, our math tells us that your average middle-class American is going to be in the 40 to 50% tax rate, probably by about 2030, plus or minus a couple years. And yes, that's gone up. It used to be 40 to 45%. It's the range is higher. And if you have several $1 million in your IRA, you're likely to be plus this. But if we know taxes are going to be significantly higher in the future, and they just must be, then it can make sense to pay your tax now, take the appropriate amount of money out of your traditional IRA, redeposit it via conversion to your Roth IRA or Roth 401k, and then never have to pay that tax again. All sounds great. You've got to be careful, because sometimes it does not make sense to convert to a Roth IRA or a Roth 401k or other Roth plan. So now we understand what a Roth conversion is, right? So we talked about that. The benefits we talked about: forever taxed to never taxed again. Once you move that money to a Roth IRA, That's your benefit. You're never taxed again on that money. You can withdraw the principal if you want to, and you don't pay tax on that, of course. You don't pay tax on any contributions, on any conversions. And if you meet the requirements of the 5-year rule, you don't pay tax on any growth. I get asked that question all the time. But what about the growth? I had an attorney who said, no, you got to pay tax on the growth of it. No, you don't. As long as you meet the 5-year rule, you don't. The 5-year rule is very complex prior to age 59 and a half. It's very simple after 59 and a half. So don't worry. Pay attention to it, but don't worry about it too much. There are also ordering rules that make it very, very challenging to violate that 5-year rule. But we want to overcome some of these risks. We want to overcome tax rate risk. And that's what I talked about. Taxes being much higher in the future. Your average middle-class American to be at 40, 45, or maybe even 50% or higher effective tax rate. RMDs. RMDs are forced out. That's a required minimum distribution. Once you reach certain ages, age 73 right now, you must start taking money from your IRAs, your 401ks, anything that lives in that tax-deferred bucket. The IRS determines exactly how much you have to take, and if you don't take that money, they penalize you up to 25% of what you should have taken out. And if you think 25% is a lot, just a couple years ago, that was a 50% penalty, 50% penalty. Roth IRAs and Roth 401ks now have no RMDs. So you get to determine, you have more control over your money because you get to determine how much you want to withdraw from your retirement plan. Isn't that a good idea? So you can eliminate having to take out more than you need. Cash flow. We see that with proper structuring of Roth conversions and other tax efficient strategies, you actually end up with significantly more money and more cash flow. Most people that we see. Many people we see end up with significantly more money and more cash flow, in later years of retirement, especially by using tax efficient strategies. So you get to spend more money. If it's a goal of yours, you could get to leave more money to your heirs. But most people are concerned about their needs in retirement, and time again, we see that there is increased cash flow and increased assets by using tax-efficient strategies, including Roth conversions. So there are some of the benefits in estate planning. Geez Louise, this one's often overlooked, but if you're going to leave any money to the next generation, or if you're listening to me and you think that you're going to inherit a significant amount of money from an IRA, for heaven's sakes, have a conversation with whomever's going to leave that money to, your parents, a rich uncle, whoever it might be. Talk to those people about potentially converting that money from traditional IRA to Roth IRA before they pass away, because it's going to be a forever tax headache for you. If you inherit an IRA, you cannot convert those funds. You don't have the option of converting those funds. So the Roth IRA, Roth 401k, anything Roth is an absolute gift, again, from an estate planning point of view. So a lot of benefits to it. But when do we want to consider not converting? We don't want to trigger an unnecessarily high tax rate. So what does that mean? Well, follow me over here. These are our tax charts that we have from the Ed Slott group. And you can download these from our website. If you go to the Slott corner on our website and go into that resources, I think it is tab, you scroll down and you can download these. You just have to put in your email and you can download. So you'll see that married filing jointly and single filers are listed here. And you'll see that the top of the 22% bracket stops for married filers at a taxable income amount of $201,050 for 2024. For just 2% more, you can cross into the 24% bracket, and you're at $383,900. So we often say, well, geez, just for 2% more in tax, we can convert a lot more money. Obviously, the numbers are very different for single filers. They're basically cut in half, or they are cut in half. And that's one of the reasons that you may want to escalate Roth conversion strategy if you're a married couple, because one of you is going to pass before the other. So once that one person is gone, that one person left inherits all your money, or whomever passed, and then they've got a much higher tax rate, likely just because of their filing status. So it may make sense to push all the way up if you're a married couple into $383,900 and take advantage of that 24% bracket. For some people, it may make sense to go into the 32% bracket. For some people, it might be 35. For some people, it may be 37. For most people, it's not. For most people, you can probably get the work you need done right around 24. Depends on your risk tolerance, tax rate, risk tolerance. You might want to push up into the higher levels. Sorry, I was cutting that off a little bit. But time and time again, I have people who come to me and they say, I read some books and I watched some videos and I'm really excited about these Roth conversions. And I already started doing the work. So I say, that's great. Tell me about what you've done. And he said, well, I converted $1 million last year. Well, okay, some people may have to convert $1 million a year, and if they have a significant amount in their IRA, that might be the right number. It's not typical, I'll tell you that. So people get excited about it, and they say, okay, I just want to get this over. And suddenly they jump up into a much higher tax bracket than needed to be. Some people, it makes sense to be at 37. There are reasons sometimes that, if the future of your tax rate is 50 plus and you're converting at 37 and there's no road for you to convert at 22, 24, then that might be the best option for you. But that isn't for the majority of people. People get excited, and it is exciting when you learn. I remember I was excited when I learned about these strategies way back in 2012 and I started implementing them. And you can get overrun with it. But be really careful not to convert at unnecessarily high tax rates. So I hope that makes sense. Charity. This is a big one that most people don't consider. So this fella who initiated this webinar today, he said to me, I'm just kind of making up numbers here. I got $500,000 in my Roth. I have $2 million in my traditional IRA. He said, and I want to convert the rest of the traditional IRA to Roth. He said, but I'm not leaving any of it to my kids. They have enough. They've done well. I'm not leaving any of it to my kids. I'm done with them. Not in a negative way. He just said, they're good. I took care of them, or they've taken care of themselves. Not leaving any of it to my kids. And I said, well, where are you going to leave it? He says, I'm going to leave it to my church. And that's fine, whatever charity that is. And I said, well, you don't want to do another nickel. Again, you probably don't want to do another nickel of Roth conversions. Because he was talking about how to spend down his RMDs, and that's he was being very strategic about these things, and that's all good. But I said you may not want to do one more nickel of Roth conversions, because if you're going to leave everything to a charity, the charity's not going to pay tax on that the $2 million IRA or whatever it grows to. If it grows to $1 billion, they're still not going to pay tax on that charitable organization under the current tax code. So why in the world would you convert $1 of it, pay 24% or 37 cents, whatever your tax rate is on that dollar, unnecessarily, when your heirs, being a charity, are never going to pay a nickel of tax? And he said, I didn't consider that. He also told me, though, that he was taking advantage of these things called QCDs, qualified charitable distributions. He said, well, geez, I've been sending them. My RMD is about $75,000. I've been sending them about $30,000 and living off the rest. And I said, well, you might want to consider, you can spend or send up to $105,000 each individual, for a year to a qualified charity directly. So if your goal is to leave money when you're no longer here to a charity, you may want to start during your lifetime. Send it right to the charity. You don't pay tax on that. And even if it wasn't, it doesn't have to be $105,000. It can be a portion of that. Maybe it can't be $105,000. Of course, you have to make sure your needs are taken care of first before you send anybody any money. Make sure that your needs are being taken care of. But it makes sense. It potentially makes sense for this individual to never convert again. Why wouldn't this individual, going back to our brackets, and let's just fill in the numbers here. If we've got $2 million sitting over here and they have $500,000 over here, why wouldn't they live off of this money for as long as they could? Or do a proper financial plan, draw their needs out of the tax deferred bucket while taxes are still lower than they're likely to be in the future, pay a 20, to 24% marginal tax rate to cover their needs. He says he lives very modestly, so maybe it's not even that level. Maybe he's at a 10% tax rate just to cover his needs. And then when you hit that certain balance that makes sense, well, then start sending this money via QCD, or maybe you do it while you're drawing down for yourself as well, and then start living off of the Roth IRA. Because listen, if he's going to leave something, anything at all to the kids, it's much better to be here out of the Roth IRA. So I hope that makes sense. The first thing is charity. Pay attention to those beneficiary designations and where they go. And also, because you can do, like I said earlier in this, you don't have to have these complicated trusts in your IRA. And for a lot of trust as beneficiaries and IRAs, it doesn't make sense anymore. It was very popular to have trusts as beneficiaries prior to the Secure Act, but with the elimination of the stretch IRA for most people, except those eligible designated beneficiaries, most of these trusts don't make sense. So if you have a trust in your who is the beneficiary of your IRA, and you haven't reviewed it since in the past few years, since the Secure Act came out, then you must do that. You should have that reviewed, because that could be a level of complexity that makes zero sense in your plan. So pay attention to those beneficiary designations. That's an area where it may not make sense to convert. You can take advantage of QCDs. If you're charitably inclined, you can send those funds directly to the charity. You have to be over 73 years old. There are rules around this. So again, use this as a guide, not as advice. This is education, not advice. But you may want to consider qualified charitable distributions. This is now adjusted for inflation, but it can be up to $105,000 per individual. You can't QCD for somebody else's RMD. But that's a consideration. That's where it may not make sense to convert. If you're going to leave money to charity, if you're not going to leave it to beneficiaries, who are people, and some people will say to me, "Well, geez, I've got $400,000 in my IRA, and I really want to convert this." Sometimes I say, "Well, it doesn't make sense." It doesn't make sense because you may not have to convert any of it, and you still can withdraw those funds tax-free. So if we just go back to our document here, our tax form, everybody has a standard deduction. So your standard deduction for a married filing joint is, if you're less than 65 years old, this is for 2024, is $29,200. If you're over age 65 or blind, and if you're over age 65 and blind, you get a little bit more, but you get another $1,550 each. Single filers, of course, yours is less, the standard deduction, and we want to pay attention to that. But remember what I said about this person. He said, I'm just going to come over here. He said, my RMD, can you see this? Yeah, my RMD is about $75,000 a year. So if he doesn't have any other income, and he doesn't, his Social Security and withdrawals from his IRAs, what if he drew this down just to a level where his required minimum distributions were offset by his standard deduction? Well, let's look at it another way. I mean, that's one strategy, but let's look at it another way. What if a person has $400,000 in this tax-deferred vehicle? Let's make a new one. $400,000 in this tax-deferred vehicle. And I need my calculator here. Their first year RMD, stay with me, will be about, let's just call it $14,000 roughly. So that $14,000 from an RMD, if you don't have any other income, is $14,000 less than the standard deduction for a married filing joint couple of $29,200, even without the increase for the amount over 65. So we got to add 15. What was it? 1550 each. 1550 each to that. So is that 14,000 less than the 29,200? Just lost my calculator. 29,200 $32,300. Well, of course, the answer is yes. So this 14,000 is less than 32,300. So you still have room for other use of that standard deduction. If you are overzealous and say, hey, you know, this is my tax deferred bucket. These are my IRAs. And I now read about Roth conversions and I want to convert that money over here to Roth. And I talk to somebody and they have a schedule of, or I've put together my own schedule. I want to do $100,000 a year for the next 4 years. You might be really happy with that and think, okay, good. Now I've taken this down to zero. And now I'm going to have $400,000 plus growth over here. And I'll never pay tax again. Well, it could be that you never had to pay tax to begin with, because if you didn't have any other income, your $400,000 is going to generate a required minimum distribution that's below your standard deduction. You get to deduct. Your standard deduction means you get to deduct that income. So if you can deduct $32,000 off of $14,000 in income, you still have room. That means you pay zero tax on that $14,000. This is missed all the time. So now you might say, Mark, why don't we go more then? What if it's $800,000? Because a married filing joint couple, up to $32,500. Here's where I err on the side of being conservative and take this piece of education again. One of you is going to pass before the other. Once you pass away, your standard deduction, remember, let me erase this so we can see. Your standard deduction cuts in half, basically. So you lose the extra $1,550, right? You go to $1,950. You get a little bit of an increase there, $400. But you go from $29,200 to $1,460. So now suddenly you can be in a position where you're paying tax. So you don't want to be overzealous about Roth conversions, because you may have an amount in your traditional IRA that's not worth converting anyway, not worth it, but from a tax point of view. Or you may have $1 million in this IRA and someone advised you to take it all the way down to zero when you could leave $400,000. Maybe your number is $200,000. Let me say that I'm using $400,000 as an example. $400,000 is not your number. It's different for everybody. Your number might be $200,000. Your number might be $400,000. Your number that you could leave in your tax deferred bucket might be zero. If you have other income, if you have pensions, if you have rental income, if you have things like that, then your number might be zero. But you have to look at what that number is before you come up with your conversion strategy, because in fact, it may not make sense to convert if you can produce an RMD that is less than your standard deduction. But be careful. We want to pay attention to the married versus single, because if you're single, it's a little easier to do planning because you already have a single mindset. If you're married, I am always shocked at the number of people when I say, well, one of you is going to pass before the other, and they say, ooh, I didn't think about that. And that's a big impact. Your tax rate changes dramatically. You lose your standard deduction. Most of you are still living off of your standard deduction. That's what you're claiming is your standard deduction. That's what I find. Most retirees, by the time they get to close to retirement, they've lost all their other deductions and they're dealing with their standard deduction. So there are times, folks, when it doesn't make sense to convert to a Roth IRA. You don't want to pay unnecessarily high tax. If you're charitably inclined, see if there's money if any of that money that you're going to leave to charity is IRA money. You do not want to convert that. You likely don't want to convert it because that charitable organization will never pay tax on that money. Why would you pay tax when the people you're going to leave it to are never going to pay tax? you can take advantage of beneficiary designations to get that money to the right place. You can take advantage of qualified charitable distributions to distribute that money during your lifetime. You don't have to wait until you pass. So there's a lot of ways to manage a tax efficient strategy if you're charitably inclined. If you're not charitably inclined, then that's not for you, and that's okay. Maybe it makes sense to do Roth conversions if you want to leave as much as you can to the kids or your heirs, and you don't want them to worry about tax, then, or whatever's left even. If you say, I want to make sure our needs are taken care of, which this is how most people think, I want to make sure our needs are taken care of, and whatever's left passes as most efficiently as possible to my heirs. And most efficiently typically means time and tax. So beneficiary designations is the best use of time. Roth IRAs and life insurance policies are the best vehicles for tax. And the last thing, and there might be other reasons too. And if you're an expert, if you think of another reason why it may not make sense to convert to a Roth IRA, and I just thought of one, but the other might be that you can maintain a balance in your traditional. You may be able to maintain a balance in your traditional IRA that generates a required minimum distribution that is below your standard deduction. Therefore, you won't pay tax on that distribution, absent any other income, of course. And if you have pension income or real estate like rental income or other income, then that scheme won't work for you. But that is a time potentially when you would not convert if you can maintain that balance in your traditional IRA. The other one that I'm going to add here, let me go back to the screen. I just thought about it, is cash flow. You have to pay the tax. On a Roth conversion, you must pay the tax. If you don't have the assets to pay the tax, and if you're below 59.5 and you can't even do withholding to pay that tax, then that strategy may not work for you. So there are things. And if we talk longer, I may come up with a couple more. But there are times when it does not make sense to convert. How do you figure these things out? Folks, you work with a qualified financial planner, of course, not just any old financial advisor, not just any old stockbroker, and not just any old, even certified financial planner. This is a very specialized area. I've been doing it since 2012. I've been focusing on this area. I've been doing this work since 2001. But everything changed for me in 2012 when I met a fellow named Ed Slott, attended one of his events, and it's been a wonderful experience. Since then, we have the opportunity to change people's lives by often producing more cash flow for them, more assets for themselves, for their heirs. The comfort of being tax efficient or tax free in retirement is really very exciting when you're just completely remove a future risk that most people are just going to wake up to one day and they're going to say, darn it, I wish I knew about this. I've never had someone who sat across the table from me or sat across the webcam on a Zoom meeting who said, geez, I wish I would have waited a little bit longer to do this. So take advantage today. Arm yourself with this education. If I don't know you and you want to schedule a 15-minute consultation, you can do so by contacting us at questions@attleborowealth.com. That's questions@attleborowealth.com. If you're a dear client of ours, just reach out to us. You know how to reach us. You've got your own special emails and your own special access, and we'll see you as soon as possible. Nearly immediately. And if you have anything you'd like us to talk about in a webinar, send me an email also at questions@attleborowealth.com. That's questions@attleborowealth.com. I see a lot of comments flying in here. So after we're done here, I'm going to take a minute to read them, and I'll comment the best I can. Otherwise, folks, have a great rest of the week. We will see you next week. There's no holiday or anything. There's a holiday next week, but not until Thursday. So we'll see you next Wednesday. I look forward to it. Talk to you soon. Take care.